Welcome to FuturesOptionsETC.com's online options trading tutorials. You can also visit us on our website www.FuturesOptionsETC.com, or for any special training needs you can contact us at training@FuturesOptionsETC.com for a dedicated trading tutorial session. You can also visit us on our website, that's http://FuturesOptionsETC.com, where you'll find a lot of articles explaining the true payoff functions, detailed examples and graphs on how to trade options using different option strategies. There's also a search feature available on this website which you can use to search for your desired option strategy and browse through the results. In this option trading tutorial video, we are going to look at long straddle option trading strategy. Long strangle option trading strategy comes handy when you are expecting a big price movement in the underlying stock price, but the direction of that price movement is not known. An alternative strategy to trade is the long straddle, but that is something which might require considerably more amount of money initially. That is, the capital requirement in long straddle is more because we buy ATM or at the money strike prices option in long straddle. In long strangles we go for slightly OTM or out of the money, so the money requirement is less. So let's say, for example, IBM stock is currently trading at $50 per share, and you as an option trader believe that the price will either rise to $80 or might fall down to $20. So this is like a big price move in which can happen in either direction, but this price move is expected, but the direction of this price movement is unknown. So this makes an ideal scenario to trade long strangles. As I mentioned, long straddle is another equally good strategy, but in this tutorial we'll focus only on strangles. So what do we do for making up a long strangle? We purchase one call option and another put option with slightly OTM call strike prices. So since this IBM is currently trading at 50, let's say we buy the call at a strike price of $60 and the put at a strike price of $40, and both these are costing me $2.5 each. So the total option premium I pay for making up this long strangle position is $5. The benefit of trading long strangle is that they come with unlimited profit potential, as we'll shortly see in the payoff function. They come with a limited loss. The loss is limited because you know that this is the maximum amount of money in terms of option premiums that you are going to lose, and there's no margin money required. So say in case of profitable scenarios, suppose your prediction comes true and IBM stock price actually reaches $80 on the upper side, then your profit would be $80 minus $60 for the call option, and you have paid $5 for the two option premium. This particular option would expire worthless. Only this profit is from the call option, and the option premium that you pay has to be deducted, so net profit is $15. In terms of percentage, it is a whopping 300% profit. On the lower side, if your prediction comes true and IBM stock price reaches $20, then your profit will come only from the put option, and that would be $40 minus $20, and this is the option premium that you have paid up front. Again, the profit is $15, taking it to 300%. On the risk side, where you can suffer the loss is when the price movement does not happen in big volume as you were expecting. So suppose that IBM stock price does not move much and it remains between $40 and $60, then what will happen is that both the call option and the put option will expire worthless, and you will lose the entire total premium for both the options, and that is your loss of 100%. So long straddle provides you with unlimited profit potential, provided that you are able to get a good move in the underlying stock price, and loss is limited to the option premium that you pay. It's considered one of the safest strategies to trade when you're willing to risk all the option premium and can generate multi-bagger returns in terms of many-fold returns coming in, as we have seen up to 300% in this example. Typical scenario to trade this would be when you are expecting a quarterly results announcement or company bidding for a project and getting the project assigned, or depending upon the outcome, price of that underlying stock moving this way or that way. So let's now get into the payoff function for this. What we are doing here is we are purchasing a call option and a put option. The call option is at $60 strike price, so this is how its payoff function for the call option will look. And then we are purchasing a put option with a strike price of $40, so this is how the put option payoff function would look like. Now to add these two, it's very simple. Between 0 and 40 in this region, the red call option graph is at 0, and this is the put option function, which is slanting downwards. So slanting downwards plus 0 will give slanting downwards function. So this is how it would look like. Similarly, in the range of 40 to 60, both these functions are 0, the blue and green. So you will have a 0 line as net, and then above 60, blue graph is 0 while the red graph is slanting upwards. So we'll get this as the net sum of the payoff function. So this green graph, which is in a kind of elongated V shape, that tells me the net payoff function for the long strangle options trading strategy. However, this green graph still does not include the price into consideration, which is in this case 2.5 plus 2.5, that is $5 a net outflow from our pocket. Hence this needs to be accounted for. Therefore this entire green graph will have to be shifted downwards by the total price of 5, because it's a net outflow, so it is considered to be negative. Now let's shift this graph downwards. So whatever is at 40 will come down to 35, and whatever is at 0, that is this, would come down to -5. So this is how it will be looking. Okay, and then above 60 it would be like this. So this is how the long strangle option trading position and its payoff function would look like. What this tells me is that above 30, that below 35, this is one of the break-even points, and above 65 is another break-even point. So these are the two break-even points, either side of which I'll have a profit area and a loss area. Here I can see that above 65 I have profit potential. As the stock price will keep on increasing, my profits will keep on increasing linearly. The more the underlying stock price moves in the positive direction, the more profit I'll make. At 85 I'll make profit of 20, at 95 I'll make a profit of 30, at 100 I'll make a profit of 35. Similarly, if the stock price goes below 35, then I'm going to start making profits again. So at 25 I'll make a profit of 10, at 15 I'm going to make a profit of 20, at 5 I'm going to make a profit of 30, and if the company goes bankrupt and stock price reaches 0, then I'm going to make a profit of 35. So there are two profit areas. One is on the upper side and other one is on the lower side. Then the loss area is confined to this region, that is between 65 and 35. This is how my loss will be. The loss here is capped or limited to a maximum value of -5. That's the option premium that I'm going to lose if stock price remains between 40 and 60. Between 60 and 65, my loss will start decreasing. It will still remain a loss because it is still negative below the 0 line, but it will be limited. As soon as it crosses 65, the loss will start turning into profit. Similarly, between 35 and 40, the loss will start reducing as the stock moves lower, and it will cross and become profit when the stock goes below $35. So this is how the long strangle option trading strategy and its payoff function look like. Basically a good strategy to trade because it has good profit potential on either side.